Hey, everybody. Charlie Jewett here with the Renovating Retirement Podcast. And I wanted to take a little bit of time to talk about kind of what to do with asset allocation or, balancing your portfolio, kind of what to do with all the changes going on in the world, and some of the things that have kind of been happening in the stock market in the last, 20, 30, 40 years. When times change, we have to make adjustments. Sometimes they're small, sometimes they're big, but I want to talk about a couple of adjustments that we've been making here at the Renovating Retirement Podcast and all my companies, and to try to get people the growth that they're kind of used to. Now, if you don't know who I am, you can look me up on Google, Charlie Jewett, and find my books and what I do in the world. My probably, I don't know, biggest claim to fame is probably a podcast I've had running for 4 years. And if you want to find the podcast, you can type Renovating Retirement. You can go to my website, jewettwealth.com, or you just type Charlie Jewett and you'll find, I think we're up to 176 episodes or something like that. But let's jump into this. For the longest time, and this really worked well, I'm going to show you in a moment, this really worked well last century. For the longest time, kind of portfolio theory, and you can tell this person has a very conservative portfolio. It was kind of a mix between cash and, really bonds and equities. It was a blend of different types of things. We have some money in cash waiting for stocks to drop in value. Like we just had the coronavirus, crash that kind of lasted for a short time. Now it's kind of climbing back up, but having money sitting in cash, the whole idea was when the stock market would take those 30% crashes, you jump right in with your cash and buy and then ride it back up. And that's how we got a lot of our growth. This person is probably older, so they've got a lot of their money in fixed income securities or some types of bonds. If it was a younger person, we'd probably see 70, 75% in equities and then a small sliver in bonds. But this idea of having some in all three of these pieces is basically asset allocation or modern portfolio theory or portfolio management, or at least it was for a long time. And the idea was kind of like this. If you look at the red side over here, you've got maybe $300,000, let's say, preparing for retirement. Forget what age you are right now, but if you have $300,000 that you're managing, you might have some of it in cash. So maybe, 10%, you've got some in bonds and you've got some in stocks. Now this might be different for everybody and we can change all the numbers. That's fine. But the basic idea in the past was, back when cash paid some money, have money sitting there, not even keeping up with inflation, but making something, waiting for stocks to crash. Have the bonds giving a nice, consistent, safe, hopefully 5%. And then stocks, I'll show you a time frame where for 29 years, they actually made almost 14% compounding. So to shoot for 8, 9, or 10 was very realistic for quite a while. So we're kind of hoping the stocks kind of hit a home run. In this case, maybe make 9. And so over a 30-year period, maybe you don't have 30 years, that's fine. Right now, I'm just teaching conceptually. But over a 30-year period, it may, this $300,000 portfolio may grow to $2.5 million, which you can certainly retire on. And that would give you a rate of return of about 7.5. So if you put 300,000 somewhere for 30 years, compound, you get to about 2.5 million. So we're making about 7.5%. And that's the basic idea of asset allocation, at least the past version of it was have a little bit in super safe, have some of it in very safe, and have, based on your age, have the rest really working for you. The more time you have to recover, the more time between now and retirement, the more you could have in the stock side, because if you take a crash, it has time to recover. So that was the basics. Now, on to what has changed dramatically in the world. This is the major concern at my firm and for all the advisors and clients that I work with, is we're not in the same situation we were last century. So from 1970, just watch what I'm doing on the screen here. By the way, this is a calculator available to everybody. Just type CAGR, stands for compound annual growth rate. Type S&P CAGR calculator into Google and you can find this. If I hit calculate here, this 29-year period from 1970 to 1999 was incredible. The market compounded real rate of return, cash on cash, true compounding, at almost 14% for that entire 29-year period. That makes up for a lot of mistakes. Nobody really had to think about anything. We didn't really have to worry about my 5 lives of retirement, long life, short life, rough life, sick life, the next life. It was just, everything was fine. We're making enough money to not really think about it too much. Having extra money solves a lot of problems, makes life kind of easy and simple. The issue is that we still think and act and function, particularly a lot of the big money management firms, Edward Jones, Merrill Lynch, Morgan Stanley, they still think, act, and function like the market still behaves that way or will for the next 20, 30, or 40 years. But take a look at what data we have from this century. Now, this would be on December 31st, 2019. And for the year, as I'm recording this in June, we're actually down. So I don't know where the year's going to end up, but this is as of a high point on New Year's Eve. We had only made 6.01% before fees and before taxes for a 19-year period. 6 is dramatically less than 14, by the way. Take a look at this just to have some fun. Here's a 6% compounding over here. So if somebody has, let's say, $300,000 at 6% in 30 years, they'd have 1.7. Well, at 14, they would have had $14 million. You say, well, hold on a second, Charlie. 6 is right around half of 14. Why don't they just end up with half of that money? They have 14 million. Why don't they just end up with like 7 million? Well, that's just not the way compound interest works. The reason compound interest was called the eighth wonder of the world is with every increase, 1%, 2%, 3%, or if you double from 6 to 12, that's not double the retirement. If you look up here, it's like 6 or 7 times the retirement. So this is a pretty big deal, like really life-changing big deal that the market for 20 years. Now, am I saying I know what it's going to do for the next 20 or 30 years? The answer is no. And that's why we suggest not gambling. What if we have another 20-year period like this? Well, so how do we fix this problem? This is not a doom and gloom, recording. We need to look at some other asset classes and sort of throw them into the mix. We don't want to just stick to what worked 20 years ago, cash, bonds, stocks. We want to look at some other things, PRAs. I'll talk about the A word in a minute here, land. Or if stocks are only going to make us, our 5, let's stick them on the bottom. Let's put a small portion in stocks until they can come back and prove that they're worth the bigger portion. Talk to it like a subcontractor. Hey, buddy, you're not really doing a good job, but I'll keep you on the team. And if you can prove to me that you can make 14% again consistently, I'll throw some more work at you. Just talk to the stock market like it's a subcontractor. Well, let's talk about land for a moment. Land banking is something that's become really exciting for me as an asset class to kind of mix into portfolios. 10%, 12%, 15%, 20%. Some people go all in. Some people put, 80, 90% of their money in land because they like the fact that you don't lose money and that it's not correlated with the stock market. It doesn't go up and down. The mystery is how long do you hold it? 3 years, 5 years, 7 years, 10 years? That's the only mystery. I can share the average of about 3.7 to 5 years. But the mystery is not whether you're going to lose money or make money, that we've made consistent money with land. So if we can mix a little bit of land in, that works tremendously well. Now, what does land make? Now, this analysis is done in 2012. So that's a little old. It's 8 years old. But if you look at the area and who's putting money there, Warren Buffett, Arnold Schwarzenegger, Ted Turner, high-speed train going in, 6 Walmarts. If you kind of look at the area and what it's done in the 8 years since this, you probably won't question whether it's still appreciating like this. But take a look at this 17-year study, finished in 2012, and it found if you throw out the top 10% and the bottom 10%, the average property, if you just bought land and held it in this area for a 17-year period, went up at 24% per year for the entire 17 years, and the average hold time was just under 4 years. Well, 24%. Let me come back here for a moment. I have a special feature in this spreadsheet because I like to geek out on spreadsheets. And look at this. Inside of this spreadsheet, if you have that $300,000 at 6%, over 30 years, end up with 1.7. If you were to have that in land or anything at 24%, you end up with $190 million. Or how about a 10-year period? Turns into $530,000 versus $2.5 million. I am not telling you we're going to make you $190 million in 30 years, or that we're going to make you $2.5 million in 10 years. What I'm telling you is the stock market has performed terribly for the last 20 years, and we need to start trying different things. We don't just throw your retirement away and go, oh, well, the stock market wasn't nice to me. We can put more thought into it than that and get experimental or throw some, use some other asset classes. We have easily made 12 to 15 consistently, even though that number says 24. Making 12 to 15 is not something I would be afraid to talk about at all inside of a portfolio. So what does that mean for us? Well, if we can have some land inside of a portfolio over here that's maybe making 12%, and the stock market, we call it 5, even though it's been around 6, we'll talk about what to put here in the middle if you want. I mean, we could eliminate the middle. You could just do land and some stocks. That's fine. But if we put something here in the middle, we may end up with, 116% more money at retirement, just having a little bit of a different asset allocation. So what's another option, another alternative investment? I do focus groups and webinars on this all the time. Alternative investments that don't go up and down with the stock market. Well, Some people don't even know that this is possible. Hold on a second. Let me find where I put my sheet. Some people don't even know that this is possible. You can invest kind of in the market. They're going to link you to a market. By the way, before I share this, I'm going to use the A word. Uh-oh, brace yourself. I'm going to use the A word. Notice, by the way, this ends in 2015. I'm not showing it as current data. I'm showing it as how the tool functions. There's an A word called annuities. And annuities used to be really bad for families because the only annuities that existed, or at least the popular ones, were something called a single premium immediate annuity. You had $500,000 when you retired. You gave it to an insurance company and you gave it up. You didn't have any of it. They have it in their pockets. You don't have an account. You can't borrow from it. You can't take withdrawals. There is no account anymore. They just pay you an income until you die. It was the trading of your assets for a paycheck. You're basically creating your own social security where there's no account. Nothing really can change or can be improved. You can't have a good year where you make a lot of money in the market. There's no money to be made. You just have a paycheck for the rest of your life. And if you die, they keep all the money. Well, of course, people didn't like that. And families got upset when the parents put the entire estate into an insurance company and they got hit by a car and the family had nothing left. Annuities have come so far since then. Do I love all annuities? No way. Would I ever be so obnoxious and amateur and unprofessional to say I hate annuities and you should too, or throw the baby out with the bathwater when the word literally means contract? And the answer is no. Every annuity contract has to be evaluated for its own merits. If somebody came out with an annuity contract that said when the market goes down, you get nothing. When the market goes up, you get 100% of the gains, I'd go, I'm in all day long. Now, we don't have that. That would be perfect. What we have, what truly does exist in the world and has literally changed, hundreds of people's retirements in my life, is annuities that when the market goes down, you cannot lose a penny. There are no more losses. The reason the stock market has only made 6% over the last 19 years is we have 2 or 3 big crashes. We had the dot-com bubble and then the mortgage meltdown. It is the loss of money that lowers the rate of return. The annuities that exist today that you can use for qualified money, so IRAs, 401ks, things like that, you can use it for non-qualified money, but I'm kind of talking about retirement accounts in a sense here. You can, oh, by the way, with land, I didn't tell you this, with land, you can transfer 529 plans. Actually, I think I have it pulled up. Do I have it pulled up? I think I do. You can transfer all of these types of accounts into, where is it? There we go. Into land. You can do traditional IRA, Roth IRA, SEP IRA, simple, 401k, 403b, any defined benefit account, trusts, HSAs, which really surprised me, pretty cool. ESAs, 529 plans. What a big deal. If your kids have 7 to 10 years before they have to go to college, you can grow that 529 plan significantly in land. And there's no taxes. It just transfers straight across. So it's still pre-tax money if that's what you want. Same thing with these accounts. You can use annuities where when the market goes down, these big crashes here, you never lose a penny. We're just waiting. Okay, boom, time to earn money again. And you might only get half of it, or you might only get 80% of it, or you might only get the first 12% of it, or whatever it is, first 6% if your annuity is set up improperly, but we want to fix that. But you get some of the ups, none of the losses. Every way I measure this, listen close. I have a podcast where I've been asking advisors to challenge me and debate me for 4 years straight. Since May of 2016, there's not a single person on the planet that's ever stepped up to the plate and said, I'm going to debate you, because when they go do the research, they find that I did the research first, and I'm right. There is no time frame that we can find where the actual market is beating the best annuity and indexed tools, where not losing money protects you, and then you just have a high watermark and you're stair-stepping up, up, up only. The worst thing that can ever happen to you is you go sideways. Well, wouldn't you want to be sideways if there's a huge crash? Isn't that like you just went to cash? You're a genius. You're a clairvoyant. You got out of the market and put all your money in cash right here, and then boom, it crashed, and then boom, it crashed. And then you sensed it was going to go up, and you got back in to the market. You made a little, and then boom, it started taking off. What you're going to find, it sounds too good to be true. When you see how it works, you're going to go, that is genius. Yeah, that's why I fell in love with it. Very, very cool tool. I would expect annuities to be your kind of 5-6% range, sort of what bonds were supposed to do in the past. Now, I love numbers and I love truth. So I like doing research. I went and said, what about a 50% participation rate annuity? What's that mean? In your retirement account, if you were to transfer your money to a 50% participation rate annuity, that means, back to this picture, when the market crashes, you don't make anything, but you don't experience losses. That's a 0 year. We say zero is our hero. Next year it goes down again, you make 0. Next year, if the market went up 10%, you would get 5. 50% participation is like being a 50% owner in a business. You get half of the gains, half of the profits. So if you were to put, and by the way, yes, I am cherry picking. Somebody accused me of cherry picking. I was like, you don't have to accuse me. I'm going to brag about it. I am cherry picking. I am picking the time frame from 2000 until May of this year because it would have crushed you to stay in the market. Now, am I being unfair by cherry picking? No, I'm not, because what retirement planning is about is showing people their options. And if they're going to stay in the market, showing them their risks, saying, hey, we do have a time where if you retired and left your money in the market, it would have gone terribly for you. And we don't know what the next 20, 30, 40 years is going to be like. Are you comfortable risking your entire retirement and maybe having to go back to work in your 70s just because of your desire to stay in only stocks, bonds, and mutual funds and not go outside of that tiny little box of risk with a side of fees? And when talked to honestly and shown the other options, people always say, well, no, I don't have to use only one tool that worked from the 70s, 80s, and 90s. I can look at the modern tools and a more, how modern is modern portfolio theory is one of my upcoming podcast episodes. Well, it's not. It's quite outdated. Well, if you look at the first 3 years, if you remember the dot-com bubble that went down, 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 in the annuity for the retirement plan, you wouldn't lose any money. You'd say, hey, bummer, we didn't make any money, but it's like you went to cash and protected yourself. Good job, buddy. High five. Same thing next year, same thing next year. When the market goes up 26, you might get half of it. You might get 13 and change. Well, how much more do you have than the stock account? Every single year, you have between 11% and 112% more money in the conservative tool, which, by the way, has no fees, just like a bank CD. It's not a fee-based product. They want your money. Banks want the money for CDs. Insurance companies want the money for annuities. In the middle of this year, if we measured the two accounts, we would have had just under $1 million in the stock market and $1.2 million in the annuity without any of the ups and downs and the headaches, any of the panic, 31% more money. So back to this idea of a different set, some different tools inside of the allocation. And I can just change this to annuity. I was doing non-qualified money and a PRA, private reserve account. If it's not inside of a retirement account, you can do a PRA. And those have been earning 7 to 8% tax-free, which is phenomenal. So let's just change this to, an annuity at 6, let's say. So we've got some stocks making 5, let's say. Maybe we have some annuities making 6. Maybe the land is making 13. 107% more income doesn't mean 7% more income. That's double the assets, double the account, plus some. Now, what if you only have 7 years to grow your money? All right. Well, let's put some totals in here. I don't have them in here right now. Let's play. Let's put some totals in here. Go over here. Boom. There's one. Boom. Well, let's go down here. 7 to 10 years. Copy that booger. Come over here. Put it right here. Well, 7 years in, you'd have 554 instead of 477. Doesn't sound like a ton of money because the most important factor of compounding your money is time, the years. If you have 10 years to go, it starts to be significantly different, almost 50% more money over here. 587, 729. Then, of course, every year you go on, it gets more and more and more. But don't forget this, though. This isn't guaranteed to do this. This can go down, 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 right? Actually, the biggest thing missing from what I've talked about so far is that cash doesn't pay 2, bonds don't pay 5, and stocks have not been making 9. Haven't stocks been making 6, which is what I just showed you? Bonds are not paying 5. Cash, good Lord, is a disaster. If I give it 0.5%, that might even be exaggerating, right? Now, all of a sudden, we look at my numbers and say how these tools have been actually performing. I think I did this improperly. I think it's 0.5%, right? Nope, it can't be that because I just gave you $1 trillion. I got it right in the first place. So we have this 0.5% for cash, bonds at 3, stocks at 6. 1.2 million versus 5.3 million over 30 years. Well, how about 10 years? Just under $500,000 over here and 720. And the point that I was going to make is we don't even know if stocks are going to continue to do that. We've not seen, land doesn't go up and down like that. We've had no losses in all the transactions we've done in 12 years of land. We've had no losses. Nobody ever lost any money. In annuities, it's built in. You can't lose any money. I showed you the picture. It's contractual. It's not possible to lose money. So really what I'm teaching, and here's the mystery piece, but it's a small piece, right? So what if this doesn't do well? It only does 2%. Oh, bummer. We're still doing just fine. I went from 5.7 million to 5.2. So the message, it's kind of the moral of this short little teaching here is asset allocation important? Spreading your money around, trying to keep some of it safe, trying to have some of it hit home runs. Yes, yes, yes. But when your home run hitter, the stock market, breaks its leg or breaks its arm or shows up drunk to practice and cannot perform, which is what we've seen in the last 19 years, you've got to employ different team members. You've got to change what you use when what you have been using stops working. So this is Charlie Jewett from the Renovating Retirement Podcast. I hope that, kind of short little, piece is helpful to you. If you want to look at my stuff, you can look me up. Or if somebody gave you this video, just go back to them and thank them and, get on the phone with them, or we'll get on the phone or however we end up talking to each other. I would really look forward to helping you one day, and God bless you. Bye-bye.